Look at your last paycheck, not the number at the top, the number at the bottom. The number at the top is what you earned. The number at the bottom is what you kept. The distance between those two numbers has a name. Several names, actually. Federal income tax, state income tax, FICA, Social Security, Medicare. Each one with its own line, each one with its own percentage, each one leaving before the money ever had a chance to arrive. You did not negotiate this. You did not choose it. You showed up. You worked. The government calculated what it was owed before you saw a dollar and took it and deposited the remainder into an account you have been told to be grateful for. Now, last year, a man whose name you know, the kind of name that appears on buildings and in news articles about how much money one person is allowed to accumulate, paid an effective federal tax rate of approximately 3%. You paid somewhere between 22 and 32%. He made more in 1 hour than you will make this year, and he kept more of it. Not because he cheated, because he understood something about the structure of the tax code that you were never taught. Not in school, not by your employer, not by the bank that holds your money and profits from you, not understanding how money actually works. The tax code was not written to be neutral. It was written by people with assets to protect assets. And buried inside it are structures and accounts and mechanisms that reduce what the government collects from anyone who knows they exist and uses them. Anyone. Not just the person whose name is on the building. You. Here is the first one. The Roth IRA. You have probably heard of it. You may even have one. What most people do not fully understand is what it actually does when you leave it alone long enough. Here's what it does. You contribute money that has already been taxed. Your after-tax dollars. The number at the bottom of the paycheck. That money goes into the account. It grows. For years. For decades. At whatever rate the market provides across the time you give it. And when you withdraw it in retirement, zero tax, not reduced tax, not deferred tax, not tax you pay later at a lower rate. Zero. The government taxed you once on the way in. It does not touch the growth. It does not touch the gains. It does not touch the compounding that accumulated across 30 years while you were doing other things. A Roth IRA that grows from consistent contributions over 30 years into $700,000 or $800,000 or more produces withdrawals in retirement that the IRS does not see. The billionaire version of this is called a mega backdoor Roth. The amounts are larger. The structure is the same. The principle is identical. Tax-free growth. Available to anyone with earned income under the contribution limit. $7,000 a year, $583 a month. The price of a car payment going somewhere that the government cannot reach at retirement. Open one. Fund it. Leave it alone. That is the first rule. Here is the second. The HSA, the health savings account. If you have a high deductible health plan, and a growing number of employer plans now qualify, you are eligible for an account that the tax code accidentally made almost too good. Here's what it does. Contributions go in pre-tax. The money reduces your taxable income in the year you contribute it. That is the first tax advantage. The money grows tax-free inside the account. Invested in index funds, the same way a retirement account grows. That is the second. Withdrawals for qualified medical expenses. Doctor visits, prescriptions, dental, vision, therapy come out tax-free. That is the third. 3 tax advantages on the same account, on the same money. This is called the triple tax advantage, and it is the most powerful tax structure available in the American tax code for an ordinary person. And most ordinary people either do not have one or are using it wrong. Most people treat the HSA like a spending account. Money goes in, bills come out, the balance stays low. The correct use. The use that the wealthy know and most people are never told is to pay medical expenses out of pocket from your regular checking account when you can afford to. Let the HSA grow, invested and untouched, and withdraw the accumulated tax-free growth decades later for any medical expense you paid out of pocket at any point in the past. There is no time limit on HSA reimbursement. A $300 dental bill from 7 years ago that you paid from your checking account and kept the receipt for can be reimbursed from your HSA today, tax-free. After years of tax-free growth on the money that was sitting there, the wealthy use this as a stealth retirement account. You can too. That is the second rule. Here is the third, the 401k. You know what it is. You may even contribute to it. What most people do not do is contribute enough of it to feel the tax benefit in a way that changes what the paycheck looks like. Here is what the pre-tax 401k does that most people underestimate. Every dollar you contribute reduces your taxable income by $1 in the year you contribute it. If your marginal tax rate is 22% and you contribute $500 a month, $6,000 a year, to a pre-tax 401k, the government calculates your taxes on $6,000 less income. You do not pay $1,320 in taxes that you would otherwise have paid. $1,320. That is not money you invested. That is money the government was going to take that stayed in your account instead because you put the money somewhere the tax code told the government it could not touch yet. And the $6,000 inside the 401k grows tax-deferred across however many years you leave it there before the IRS gets its portion at withdrawal. By which point, if you have done this correctly, your income in retirement may be low enough that the tax rate on that withdrawal is lower than the rate you would have paid today. You deferred the tax to a year when you will pay less of it. That is the game. That is what it looks like from the inside. The average American contributes approximately 7% of their salary. The maximum contribution would reduce your taxable income by tens of thousands of dollars in a single year. Every dollar toward that maximum is a dollar the government calculates nothing against. That is the third rule. Now, the gray zone. The part that is legal. The part that is not discussed in the financial content you were supposed to consume and feel good about without actually changing anything. It is called buy, borrow, die. Here is how it works. You accumulate assets, not cash. Assets, stock, real estate, equity in a business, things that grow in value while you own them. As long as you own them and do not sell them, as long as the gain is unrealized, the IRS cannot tax the growth. There is no tax event until there is a sale. So you do not sell. Instead, you borrow. You take the appreciated asset, the stock portfolio, the real estate, the equity, and you use it as collateral for a low-interest loan. The loan is not income. Loans are not taxed. You live on the loan. You spend the borrowed money. You pay the interest, which on a large enough portfolio at a low enough rate is a fraction of what the tax bill on a sale would have been. The asset continues appreciating. The loan sits against it. The IRS sees no taxable event. And then you die. When you die, the assets transfer to your heirs at their current market value, the stepped-up basis, which means the decades of gains that accumulated are erased for tax purposes. Your heirs sell the assets to pay the loan. They pay capital gains tax on the appreciation since your death. Not since you bought the asset, since your death. The lifetime of gains? Never taxed. This is not a loophole. This is the code working exactly as the people who wrote it intended it to work. You are not a billionaire, but the principle scales down. If you own index funds in a taxable brokerage account, not your Roth, not your 401k, a regular brokerage account, and the value grows, you do not owe the IRS anything until you sell. You can borrow against a portfolio at most major brokerages at rates that are lower than most personal loans. You can let the asset grow. Borrow against it when you need liquidity. Pay the interest. Let the principal continue compounding. It is not the full billionaire version, but it is the same mechanic applied to a life that earns what most lives earn. Here is what all of this means when you put it together. The paycheck opens. The taxes leave. The number at the bottom is smaller than the number at the top. That part does not change today. But 3 things can change before next month. You can open a Roth IRA and redirect $583 a month into an account the government cannot tax at retirement. You can open an HSA if your health plan qualifies and begin building a tax-free medical and retirement reserve with a triple advantage that most people never use correctly. You can increase your 401k contribution by enough to feel it on your taxes, to reduce your taxable income by a number that changes what April looks like. None of this is cheating. None of this is illegal. None of this requires a team of accountants or a net worth that has commas in unexpected places. It requires knowing that the structures exist, which you now do. The tax code was written to protect assets. You have assets, or you are building them. The code does not ask how large they are before it offers you the same rules it offers everyone else. It just assumes you already know about them. Now you do. The paycheck will look the same next month. But the game you are playing with the number at the bottom is different now. And different, compounded across 30 years, is the only thing that has ever mattered.